Mary Talbutt will begin and will discuss the credit markets and her view on the impact of the Fed and central bank actions. David Gong will speak about what he's seeing on the ground in China and other emerging markets, which have an ever-growing impact on U.S. and other developed market economies. Finally, Brad will discuss his strategy and approach for generating positive returns in volatile markets and explain what the risks that are associated with this particular strategy. Market observers and analysts often call fixed income the smart money and consider the debt markets to be a leading indicator as to the health of the economy. In times of financial stress, the debt markets can often act as the canary in the coal mine to spot trouble ahead. This was clearly the case in 2008 as mortgage-backed securities became illiquid, spreads for high-yield bonds widened precipitously before the market sell-off and before Lehman Brothers and Bear Stearns went belly up. Opinions from prominent bond fund managers such as Bill Gross, Jeff Gundlach can be heard on the Wall Street Journal, Bloomberg, CNBC, or Fox Business frequently as they offer their opinions over Fed policy, which are sought out by reporters. The Great Recession of 2008 taught us that a careful and close scrutiny of the fixed income market is not only important, but it's mandatory if you're managing money in equities and fixed income. Earlier this year, I was referred to Mary Talbutt, who was in the process of a career change and was considering, amongst many other things, opening her own fund. Given her credentials, which include managing the First Vanguard Bond Fund, managing Mellon Bank's institutional bond portfolio, and then finally as the fixed income manager at Bryn Mawr Trust, it was clear that she would have multiple options and many suitors. I reached out to Mary and discussed that I felt, given our systems and our experience, if we collaborated, we could do better together. I stressed our excellent track record, our unblemished regulatory compliance record, extensive computer and analytical systems. Plus, we were pretty close to our home, had lunch brought in daily, and provided a health club membership. Something struck home with Mary. She agreed to join us in May, bringing her experience and knowledge that can only be gathered over a 30-year period managing government, corporate, and municipal bonds. Mary Talbutt.
Thank you, everybody, for coming. Welcome. I'm the new kid on the block by about 3 weeks. But it's been a great experience so far. Everybody has been just a quality team. Everybody's so knowledgeable. Everybody shares information. And what I really like is that they're looking out for the customer. That's the number one priority out there. So my presentation today is going to be a little bit different than used to. We're not really going to talk about numbers. Most people come to me and say, well, how do you figure out what you're doing? How do you decide which way the market's going to go? What's your insight to strategy? So what I'd like to do today is to invite every one of you to become traders with me and co-portfolio managers for the next 15 minutes or so. I want to give you some insight as to some of the things that I look at and why I look at them. The first 15, 20 minutes of my day are taken to look at some of the screens that you're going to see, and most of these are coming from Bloomberg. We're going to talk about what are the credit markets telling us about the economy and central bank policy effects in the long term. When we're looking at the credit markets, the one thing you always have to remember is the credit markets move on expectations. They don't move on reality necessarily. In the past 3 years, we've seen the 10-year Treasury at a yield of 163 or 136, I should say. It's gotten down that far, and above 3%. So the credit markets are not necessarily following what the central bank is mandating, but they will react to certain things. When we're looking at markets, we look at sovereign areas. We're talking about Brexit right now. Will Britain exit? I don't think it will. We're talking about Greece. Greece is having resurging debt problems. The credit markets have expected this. We didn't think that was going away. When we talk about credit, it usually refers to the corporate markets. Mortgages, something you have to be very aware of. New issue mortgages with lower coupons if you're going to buy them. As rates rise, you're extending the duration or the length of time that it's going to take for those to pay off. So that's going to interrupt cash flows. We're looking at money markets. Money markets right now, if you have businesses, you may be concerned about, what's going on with money markets because there are new regulations coming out in October where if you're an institution, you have to be in a floating NAV if you're looking at a prime or municipal money market. Otherwise, you have to move to government money markets. Well, is there going to be enough supply? What happens to the municipal markets because there's $240 billion in municipal short-term debt that's bought into some of these funds. So the Senate Banking Committee just introduced some legislation to kind of reverse those new SEC rules. We're looking at preferreds, equities, commodities. You have to give consideration to geography. When we're looking at geography, is somebody in a flood zone? Wichita Falls, Texas is talking about water reuse, so down the toilet and out the spigot. I don't think we're going to buy anything there. Brownsville, Texas always gets hit by hurricanes, so we don't buy Brownsville, Texas either. So geography is a very important thing. You look at the economy of the areas, supply and demand, which affects prices and yield curves, security structures. We'll look at yield curves a little bit later. But what's going on to make sure the issuer is financially stable, what's going on with headlines. People react to headlines almost instantaneously. So this gives you an idea of, some of the things that we're trying to take into consideration when we're forecasting. The black screens you're going to see are coming right from Bloomberg. I want to make sure I'm sourcing correctly here. We think about how do sectors and economies relate to one another. We're looking at global things, U.S. things, investment grade and high yield sectors, how they relate to each other, emerging markets. We're looking at municipal debt markets, big part of our economy. How are local municipalities, schools, everybody funding themselves? There have been a lot of cash flows coming into municipal funds lately, so we have to be very aware of what's going on with that, what's going on with ratings. We don't look at ratings per se, but I am looking at underlying ratings. If there's something's insured and it's giving the illusion of a AA rating, what happens if that insurance company goes away? I've been asking that since 1985. So we kind of found that out in the last few years with all these insurance companies having problems. We're looking at structures, refundings, supply, maturities, and this page, as we click through them, will give me more information. Here's the trick. The trick and the big secret to what I do is find the pattern. If you can find the pattern, you can find the answer to what's likely to happen and where you should be investing. If we're looking at education just as one sector, you can see the solid line there says that, okay, there's more overall issuance in education. But as the education, higher learning, do we have people going back to school because they can't find jobs and they're re-educating themselves? Are we seeing education issuance because Pennsylvania can't pass the budget and the schools need a bridge loan? That was a bad one. Interest rates, have they gone down? Are we seeing more refundings? Are we seeing people actually taking on more debt? So these are little clues to what's going on in our economy. Corporate debt markets, very important. Corporate markets, the debt markets tie into the equity markets, and we're looking at how yields relate to one another, how different corporate names relate to one another. Utilities are generally rated single A, triple B, but it doesn't mean that they're a worse credit. It's the way their cash flows in. When you're collecting money from hundreds of thousands of clients in your PICO, rather than getting a steady cash flow because you're a municipality and the taxes are coming in at a certain time of year, your ratings are going to look a little different. A lot of these ratings are based on cash flow. And, we could have a triple B utility trading just the same as, John Deere. Both are very worthwhile investments. Next. Flight to quality. This is a big subject. You know, we ask ourselves, when is this happening? How do we identify when this is happening? This is actually a 10-year IBM and a 10-year Treasury. That's right, flip it backwards. Oh, geez, okay. You know, we're taking a look at our global headlines affecting this. And that middle bar in green shows the spread or the amount of yield between the 10-year IBM and a Treasury. And the closer it gets, my decision might be to buy the Treasury rather than the IBM. The wider it gets, the more advantageous that IBM is going to be to the client. You know, sometimes it's a matter of, has Meredith Whitney spoken? You know, so then we've got all the markets going in all sorts of directions. The bottom section is what we call a regression, and we try to figure out how well are these two things correlated to each other. And it just doesn't stop with corporates to treasuries. We look at municipal markets to corporate markets and different ratings, different names. So there is correlation here, but it's not a one-to-one exact correlation. So, you know, this will affect where we feel markets are going. The next one is default risk. You know, we're used to looking at credit reports from Moody's, S&P, Fitch. Those are probably the ones that you're all familiar with. However, Bloomberg now has an investment grade rating system and a high yield rating system. So you know what? We sit down, it's something new, we take a look at it. Is it going to help us? You know, Bloomberg tries to come up with what are other traders and portfolio managers looking at. So a lot of times when you're looking at displays from them, you'll see what other people are looking at. Now, I like to take the time to call traders at different places and have conversations, and I like to get out there and visit them, because when you're sitting down, you have a conversation, you can learn all sorts of things. So Bloomberg came out with their rating system, and I was on the phone in about 5 minutes. Currency influences what you're thinking about the economy and your trading. If Japan has negative interest rates, as you can see, you know, up here, we've got a number of different countries that we're looking at. But if Japan has negative interest rates, is the currency going to appreciate? So if the interest rate is negative 10 basis points, but you get 1% appreciation, you're net 90 basis points ahead. So those are things that we need to consider, and things that we look at when we're trying to decide where is our economy going? How do we improve our total return? Strength of the dollar. If the dollar is too strong, are we outsourcing? Are we exporting our inflation to other countries because we're purchasing more from them? We went through a period of reshoring a couple years ago where we were bringing manufacturing back onto our own shores. You know, how is the economy going to digest this? So relationships between the strength of the dollar are very important for where is trade going in the economy. Market speak. How is the market speaking to you? What do you see? This is a high yield index, double B securities. And on the far left, you can see that there's this big drop in rates for the index. So the question is, if high yield returns are dropping, why are they dropping? Are they dropping because there's less issuance in the high yield market? Are there more buyers? Because supply and demand has a lot to do with where rates are going. And I know the answer to this because I cheated, I looked it up. When we look at foreign flows into the United States, there's a tremendous number of foreign money centers coming into buy our high yield securities. Everybody's looking for yield, including people in the US. This is the important one. This is the story of relative value. Everything we do with strategy and portfolio management and trading on the fixed income side centers around relative value. Where are you going to find the best value? What has the history of the pattern been? And what's unique about this is these curves are what we call a bear flattener. They're indicating to us that the front end of the curve is going to come up, the back end of the curve is either going to stay the same or come down. So the difference between 2 years and 10 years is going to get smaller given, a lack of advantage in going further out the curve to capture interest rate. So what do you do about it? And the curves on this chart, if you look in the 20-year area, the top curve is financials in 2015. The next curve down is munis in 2015. The third curve is financials in 2016. You can see there's not a big movement between the first and third one, going from top to bottom. The next one is, the fourth line down is municipals now. And there's a much bigger move in the municipal curves from the second one to the fourth one. The last two are the Treasury curve, and the Treasury curve obviously falling, but the municipal curve fell a lot more, which means yields went down, prices went up. So as a portfolio manager, it's my job to know that this is happening, anticipate that this could possibly happen by all the information that we've been looking at. And I would have been buying munis, which I was doing even in taxable accounts, because that's where the best total return is going to come in. So the idea is to take advantage of the more significant drop in yield, increase in price, and then capture that. So that's a return to your client. To quantify it, corporates moved about 50 basis points, treasuries moved about 60, and the municipal curve dropped about 75 basis points. So there is a definite advantage to the municipals in this particular instance, and that's been going on for several years now. On the credit markets, and I do have more slides. This is just the last one on the credit markets from Bloomberg here. This is what I look at every day. If you walk into my office, you're going to see this a lot. So as my co-traders, I'm going to yell over and I'm going to say, okay, where is gold trading? What does oil look like? Where's the 10-year move? And this gives me a quick snapshot of just about everything that's gone on that's truly significant in the fixed income markets. It gives me an idea of where the dollar has moved. We can see the JPY is the Japanese yen at 109. At the bottom gives me what the most recent economic numbers are. And anything that you click on here will give you all these wonderful graphs and history and all sorts of numbers that you can run. And that leads us into central bank policies and long-term ramifications. There are a lot of tools that the Federal Reserve uses. They're in the markets buying and selling securities to help move interest rates around, particularly long-term rates. They've got shorter-term things that they get involved in, repos and reverses. They're using all these tools because their two basic mandates are full employment, and it's questionable if we're there. We're talking about 5%, but is that really full employment? And price stability. Where is inflation moving? How do they control it? And they're a credit facility. They offer ease of liquidity through the discount window and targeting the Fed funds rate. They've got liquidity arrangements with foreign banks, and we're looking at, okay, which foreign banks are involved with us, who needs money. The big thing is Fed speak. When the Fed speaks, are we listening, and how intently are we listening? A couple years back, when the 10-year Treasury got to 3%, the Fed was very adamant about the fact that they were not going to start tapering back on securities purchases, that the yields were just too high. So the market reaction was to have yields come down. The problem is that we're experiencing right now, we keep hearing, well, the Fed's going to move, the Fed's going to move. We finally got a movement last December. Is the Fed going to move this year? Well, the futures market is telling us there's a 4% chance that it's going to move at the next meeting. If you talk about it too much, it now becomes a whisper, and the Fed starts to lose a little bit of credibility. They need to make a movement because they need to get a tool back in the toolbox. They're running out of tools. They need to have, a higher interest rate on the short end in case they have to lower it. It doesn't make a huge market effect, but it signals what their intention is. Policy rates, we keep a look at policy rates all around the world. You can see there's, several negative rates that we've been running into. The dollar, which currencies are moving the dollar, very important component of what's going on in making our decision of, where can we effectively invest around the globe, or do we, keep everything centered at home? Let's see. International yields. These are always interesting. If you look at Greece, there's a lot of sevens going all the way across. And what that tells us is that Greece at 7% in 2 years is a very risky business. If Greece were 15% out in the 10-year area, I would say it's going to be risky for a very long time. But because it's still got a 7 handle on it, that means the market is sort of digesting what's going on with Greece, and it's not a big deal at this point. They understand there are problems. We've seen instances where Greece had, I think it was close to 14 or 15% in the 2-year area, and it was much lower longer out, which says the problem is more immediate. In the longer term, things should smooth out. Germany, obviously, great place for flight to quality. Germany, Switzerland, and obviously the United States. The United States is a very prominent part of flight to quality. Monetary velocity. Now, this is a tricky one. We like to see how many times is money moving through our economic system. Well, according to this chart, money's not moving very fast. It's not changing hands many times. It's not providing us with a multiplier. And a lot of the problem here, you have to ask yourself, if you don't have good circulation, just like you don't have good circulation in your legs, your economy's cramping. Things are stalling, and you have to look around at reasons why something might be stalling. Why is it a slow economy? When we look at rate hikes and unemployment, again, you can see, the Fed doesn't normally raise rates during this kind of period, but they do need a tool back in the box. We've got temporary unemployment moving up dramatically. You've got a lot of students coming out of college, and they're trying to find a full-time job. They're winding up with 1 or 2 part-time jobs. You've got a lot of people who are taking part-time jobs because they have to. There's a lot of economic reasons. So you're asking yourself, who's working? Are they working so they can spend money? Are they working so they can save money? Or are they working just to pay the bills this month? That's a very real reality. This much part-time employment is not necessarily a good thing. Some common themes when you talk to portfolio managers, traders, we're looking at the central banks, and we're looking at the economy and everything going on. Negative interest rates, this is a new concept. There's more countries saying, okay, well, let's look at this. Negative interest rates are supposed to encourage banks to lend that money out or go other places for sources of liquidity. But who can they lend to? If people are out there looking for jobs and they're not actually finding full-time jobs or what they need, the earnings that they need, are these safe loans? Too low, too long is not necessarily good. It discourages, people from spending money, and you have a lot of seniors who are on fixed incomes. Interest rates are not providing enough income for them. So you have to look at it in its totality. Just the same as too high, too long is not necessarily good. When people see rates are high, they're always waiting for where's the highest point before I can get in, and a lot of times they're missing an opportunity. Again, the expanding universe of negative yields, more countries involved with it. Negative rates are moving more money into the U.S. markets. Everybody's looking for yields, and that keeping our yields depressed and, certainly not helping us move forward. And then, again, as I mentioned, with the government securities and the new money market rules, if the SEC rules hold, then a lot of these institutions will probably be moving their money into government money markets, because the government money markets can have a $1 NAV and not have to float. So, we're looking to see how much of a hiccup is there. Global leverage, since 2009, you can see that, we're picking up more leverage, not just in the US, but across the globe. How long will this last, and when does the next bubble occur? The only number on here, and you can look at these later because they're very interesting, this came right from the FDIC. There's a number here that tells us there's 6,182 FDIC insured institutions. And that's important because with all the different central bank policies, especially here in the United States, and all the regulations coming into place, it's very expensive for banks to operate themselves, financial institutions to operate themselves. They're not making the margins that they used to make. They're not able to pay for the regulations that, monitoring that they need to. So we're seeing a lot of M&As going on, and we're seeing fewer banks. Back in 1990, on the far right, there were 15,158 banks or financial institutions that were insured by FDIC. At the moment, again, there's 6,182. So if you were a regulator, wouldn't you want to monitor fewer banks? I mean, that's, and I'm sure they've had a lot to say about cutting things back. So what are the credit markets telling us about the economy? What it really gets down to, after I get done looking at all these wonderful things every day, the economy's not really out of the woods. I've never really been a proponent of the fact that we've come out of a recession. I question the fact, do we have a new definition of depression, or is this just a very extended recession that we're really trying to dig the hole out of? There's a lot of telltale signs, and some of you, your grandparents, I grew up with my grandparents, and they were talking about potluck dinners on Saturday night and playing cards. And you can see a shift in where people are spending money and how they're spending it, a lot more conservatively. In 2008, just looking at all of these screens and things happening and looking at economic numbers, I made a decision that we were going to treat the investments as depression economics. I continued to buy out in the 10 and 12-year area, stayed neutral or long any benchmarks that I had to deal with. We were continuing to look at relative value. Munis were a lot cheaper. We have a lot of issues with municipalities and pension plans, and people concerned about when things were going to blow up, and a lot of that had to do with headlines. But if I was fine with the credit worthiness of the municipality, I was buying munis. Made perfect sense, and those have been the best performers over the past few years. The portfolios that I was managing over the past few years were 100 to 150 basis points above the benchmarks, and that was buying less triple Bs than were in the benchmarks and staying out of foreign securities and just adding a little bit of duration to the portfolios. So pretty much corporate America is kind of going nowhere fast. They've laid off people, they've introduced technology, they're kind of stalling on investing capital, and the credit markets are coming back and they're saying, where's the government spending? And this isn't a surprise because, when you look at the basic formula of GDP, it's the government spending that seems to be missing. And the Federal Reserve keeps repeating this message as well. We've heard many speeches from Bernanke and Yellen asking, sort of pushing for a little bit more spending. And I think that's really what we need. And that's kind of what it comes down to. So, we'll continue to look at names, we'll continue to look at sectors, we'll continue to look at how everything relates to each other and relative value and finding the pattern.